Good day, fellow investors. One of your favorite videos for me to make every year is the 10 asset classes overview. And in this video, we'll touch on the most important asset classes out there, and let's immediately start with stocks. If you look at stocks, you want to look at valuations. You want to know how much are you paying for what you are getting. Price is what you pay, value is what you get. And if I look at the current market level, the price to earnings ratio, especially if you adjust it for recessions, earnings growth, exuberance, then you see that we are at the second most expensive market situation over the last 150 years. And even worse, the market went higher, 27% last year. The earnings yield is 3%, mostly spent on buybacks, buying back stocks that are already very highly priced. And usually after such exuberant times, this is what happened. 26 years of zero returns, 24, 15 years, and you can see maybe this will go higher, maybe not, but it's likely that we'll have a decade or two when nothing happens. And that is in line with GMO's asset class real return forecast. So US markets are likely to give a negative real return over the next 7 years. And you expect a negative return because the current dividend yield is 1.21% compared to the historical 4%. And 1% with 2-3% inflation doesn't amount to much. So stocks are very highly priced from a historical perspective. The bubble can continue, that's a given, you never know that. But from a risk and reward perspective, the reward, we have seen the yield is small, the risk is very high. The answer to that can be bonds. If you look at the returns for bonds, the real returns will likely be positive because you are getting 4% on US bonds, 3% inflation. There is a real return there. Plus, bonds, as we have discussed and shared on our value investing quadrant, have very, very low risk. Practically, if you own the US Treasury 3-month, there is no risk that something can go wrong because the US government will give you your money in 3 months. And you get 4%, 4.3% per year. We have discussed bonds in this video. As I said, 3 months short-term bonds are the safest, good yielding investment now, but be careful if you go into longer-term bonds. You can see how the risk side of things increases for the same return, which is crazy, but this is just people gambling that interest rates will go lower. This is not for investors, it's just for gamblers, and if you want safety, you are too concerned with your future from a risk-reward perspective, this is the way to go. And even Warren Buffett has 30% of his assets, of Berkshire assets, in a 3-month treasury. That's all. Now, many say that another way to get protection is to have gold in one's portfolio. And yes, gold was definitely protection over the last 5 years. When it was cheap, we did a lot of video here when we started this YouTube channel on gold because production costs were 1,000 on average, supply and demand, and the price was 1,200. Now, gold prices are more than double. There is exuberance, especially last year, and that is also because various central banks have started buying a lot of gold. Year to date, central bank gold purchases in tons, Turkey, India, Poland, China, all buying gold heavily, and that reflects then in the gold prices. You can see that they are driving gold prices in also silver has been following, but not as fast and not as an increase in price as gold, as central banks focus on gold. Now, Gold, as always, from a value investing perspective, is not a producing asset. If central banks keep buying gold, especially the BRICS here, as they are going away from the dollar in fear in who knows what, then gold prices can go up. But you are always betting on something happening in the world affecting that supply and demand. A good strategy with gold is having a fixed exposure to your portfolio. Even now, if you have a 5% exposure to your portfolio, if gold continues, it gets to 7%, you trim it down to 5%. If gold goes down, you increase again the percentage to 5%. When it goes up, you sell what you have increased and you make some profits. That would be an all-weather strategy with gold. Nothing wrong with it. You get some yield. Be careful of taxes, how much administration. And that is a way to, let's say, have some protection related from gold. But at current levels, if those central banks stop buying, gold prices go down. Related to gold, Bitcoin, and I will give you my perspective on Bitcoin, and I think I know what's going on here. It's not something revolutionary. It's something that I have heard listening to Stanley Druckenmiller. He's the best investor trader out there. He knows how these things work, and he tried to buy Bitcoin from an asset, his quadrant perspective, and he tried to buy 20 million. He could not buy 20 million of Bitcoin without moving the price. He said it took a month to get out. And now Bitcoin market cap is at 2 trillion, but is still a relatively illiquid asset compared to supply and demand. And you see here 145% from a year ago, and that is because there is so much inflows going into it. I think MicroStrategy is doing all kind of financial engineering to push the price higher, and from my experience, that strategy is something similar that Cathie Wood did a few years ago. Do you remember Cathie Wood? So they had great returns in 2020. She was buying all these companies and she was called the next Warren Buffett. The returns that year were great. She was doing that by buying this innovation companies, some new things. And the trick was that she had enough funds, 18 billion at that point in time, to push stock prices higher. This is Editas Medicine, for example. But when the fund flows reverted, I don't need to tell you the story how that ended. Chris Therapeutics, with a few billion, you can push it higher, a few hundred million, you can push it significantly higher, and then also that ended. And then we have Intellia Therapeutics. The situation there is where you have a highly hot marketed social media boom, followed with low liquidity, thus it is an inelastic market, and when flows come in, $1 coming in Bitcoin likely pushes the market capitalization more than $10 out, as we discussed in the inelastic market hypothesis. The limited supply, ride the wave as long as you can, but be careful, as soon as the flows turn, get out, if you can. I'm all happy for all of you people getting millionaires from owning Bitcoin. One of my best friends is a Bitcoin Deca millionaire, and I'm happy for him. It's just not for me because it's not an asset that is producing something. It might change the world, but for now it's just a flow game, and the same that Cathie Wood did. Be careful on the reversal. That's all I can say. Then we have REITs, and REITs have always been an interest rate game, but things are getting interesting. With higher interest rates, REITs have fallen, rebounded a little bit, but I think now flat plus the dividend, that's exactly what REITs are. Investing in REITs should be boring for those that need that yield. So check the yield. If you like it, that's it. Betting on interest rates going down that will push asset prices, REITs higher, is not something that we want to do as investors. And I have made this video. All the links to the videos mentioned will be in the links in the description below. So discussing REITs, how interest rates impact them, and if you're interested, check them out. Now, portfolio hedges. With all the market exuberance, the everything bubble, you should be hedged if you are long. Berkshire is hedged with cash. 30% of the assets are in cash on Berkshire balance sheet. That is crazy. That's more than 50% of the equity. So 30% of the stock price is cash, and therefore Berkshire is a hedge. Unfortunately, the price of the stock is just going higher and higher. Another hedging option, and if you don't want to lose your pension, then you can simply hedge by buying 1 year puts. You spend 5% of your long SAP position. If the market goes up 10%, you are plus no risk 5%. If the market crashes 20%, you are still protected. So if you have financial security that you need from your S&P 500 long investment, be hedged, spend 4-5%, and you can sleep well at night. If you want to protect, I don't know, 75% of your wealth, you can buy even lower put options out of the money, and then you are protected for 0.5% from, let's say, a 25% or more crash, but see how that fits you. You can gamble on that, you can buy puts on overvalued stocks like Walmart, like Apple, and then you can buy out of the money. When those stocks crashes, you get maybe some protection, but that is a little bit more gambling. I would stick to 3 months treasuries as Warren Buffett is, to just easy see how much you can risk on the stock market side and how much you need to just sleep well at night, and that is 3-month treasuries. The thing is to see how is that impacting your life, or how is the risk and reward of the market impacting your future. If you need that money in the next 5 years, the only option is to sell and go into bonds. If you don't need the money in the next 15-20, then you can play around with strategy. Now, on currencies, currencies are made to go worthless, especially in the system we are living in with inflation. Some analysts are saying that the dollar will weaken next year because it had a great 2024. It is impossible to predict that. In the long term, there will be good and bad times, but the dollar's purchasing power, the euro's purchasing power, is sure to go lower. So when it comes to currencies and investing now globally, my idea is if I could predict currencies, I would already be a trillionaire, and that's it. So as I can't predict where currencies will go, I always say with currencies, don't worry. Sometimes you lose, sometimes you will win, and just have a balanced exposure there over time and you will do okay. Nothing crazy to think about. Now, commodities. I just written a report on my stock market research platform on commodities, and let me just summarize it all with putting oil onto our risk and reward quadrant. I think that oil and many other commodities are now fairly priced here. So let's say medium risk, medium reward, nothing spectacular. The thing with commodities is you have fairly priced, as now Warren Buffett is buying Occidental, 10% likely long-term free cash flows. That's good for Buffett. If the stock price drops, he will buy the whole company out. And nothing wrong with that. If there are geopolitical issues, Occidental will shoot up on supply to the US, and nothing wrong with that, mid-priced. But when it comes to commodities, if you want value investing, if you want no risk, high upside, you need to buy at around 75% price to C1 cash costs. What do I mean? This is the iron ore production costs curve. So this is what it costs for all the yearly supply of iron ore to be produced. This guy, the most expensive guy related to demand, sets the price, and that is why we have high iron ore prices. These guys that are cheap producers make a lot of money on the difference here. Nothing wrong with that, but if the demand just slows down a little bit or supply increases, the price crashes down. And you need to buy it somewhere here, 75%, to have a margin of safety, which is around 60 for iron ore, and we are still far from that. As I said, now it's fairly priced, dividends, everything good, everything coming in, but to have a margin of safety, you need to wait for better opportunities, and that's what I do. I follow many commodities, we'll discuss lithium soon, and some of them here and there fall into my basket. Another asset class that I like to denominate as asset class is value. If you go to the, again, GMO 7-year asset class return, you see here that emerging value is giving the highest real return, that is with inflation around 9 to 10%. But when it comes to emerging markets, you need to know what you're doing. Warren Buffett doesn't know what he's doing in emerging markets, therefore he stays with US Treasuries. Nothing wrong with that. 5–4% is good. You don't need to chase risks. By risks here I mean not knowing what you're doing into emerging markets. Because when I look at one company that I have on my diversified portfolio of stocks on my research platform, this is what diversified emerging market value is. 6% dividend yield, 2–3% growth there, but look at the stock price. So now it is cheap, have bought here, and now we'll just have the cash flows, have protection. Later, if other pockets of the market crash, we can still reinvest that cash. But when it comes to emerging markets, you have to expect this, then there will be booms, busts, booms related to sentiment, and then down again. That's something that you really need to know what you're doing and when to buy. But if good dividend yield are something for you, then yes, you can start increasing your exposure by buying good, I know what I'm doing, emerging market stocks. Alternatives, I think Anthony Robbins has been chatting about private equity 10, 12, 13% all the time. Yes, that was the case when interest rates went down. Now it's an overcrowded market and a lot of people will lose their shirt. But let me give you another alternative that might be an interesting investment for you. Solar modules, solar panels, prices have gone down. So now might be a good time to think about putting those on your roof, make the calculations, see what are the incentives. Be careful that some markets are still selling very expensive solar panels as they want to get rid of the inventory, but $0.1, $0.2 per watt is what you need to pay. So sometimes improving your house, making a new kitchen for your wife by selling the overpriced stocks might be the best value investing you can do. As they say, happy wife, happy life. Thanks for watching, subscribe, check my research platform, I'll see you in the next video.